Hi guys, it's Bogdan here from System Traders. Welcome to our third episode of our series where we debunk holy grail trading strategies. You have probably seen loads of gurus proposing strategies that have win rates north of 70%. Today, we are going to see if that actually means anything in the real world. We are going to be using the same strategy in a few examples with different risk management techniques. We are using a simple Bollinger Band-based strategy on Euro-Dollar on 30 minutes. Please note we have set the commission, spreads and slippage to 0, hence this is a purely theoretical result. Adding them will decrease the performance. The strategy is simple. When the price curve crosses over the lower band, we go long, and when it crosses under the upper band, we go short. Let's run a test and see how it performs without any risk management in place so that we are 100% of the time in the market. This is an example of a mean reverting strategy. These strategies exploit the tendency of an asset to revert to its fair value from overbought and oversold levels. Please keep in mind that this is by no means a complete strategy because we don't use any technique for checking if mean reversion really exists in the price curve, and we don't have any exit techniques except for the above mentioned reversal. But it's enough for our example. As we can see here, the Bollinger Band strategy seems to have some strong edge using just the simple reversal rule for triggering the trades. Despite its simplicity, it produces a good-looking equity curve and very healthy performance metrics. Since 2010, this strategy has generated 3,374 trades, had a 63.6% win rate, an annualized return of 65%, and a decent Sharpe ratio at 0.89%. It's also had a maximum drawdown of just 18.2%. However, time in adverse excursion is quite high at 98%. This is just the starting point in developing any strategy. We need to be 100% of the time in the market as we can analyze the buy and sell signals the strategy is generating. But hang on a second. Just a simple strategy with no risk management? Any trader these days knows that a proper risk management is the key to the success. So let's start with a 1 to 2 risk to reward ratio where we set the stop loss to 20 pips and the take profit to 40 pips. Now notice how the equity curve has changed. This version has generated 7,158 trades since 2010 at the win rate of 39.6% and an annualized return of minus 1%. This naturally gives us a negative Sharpe ratio. As we can see, the win rate is lower and the returns are negative, so surely there is a correlation between a higher win rate and a higher return. Now let's take an even more extreme example where the stop loss and take profit targets are further apart from each other. This will give us an even lower win rate. So let's set the stop loss to 5 pips and the take profit to 500 pips. In this case, we had 8,457 trades since 2010, but the win rate dropped to a poor 13%. Now hang on, the strategy is still profitable and performed better than the previous example. We now have a 41% annual return with a 0.86 Sharpe ratio. So what happened there? In essence, we are now basically applying an early loss taker strategy where the profits are left to run. So let's see how the risk management works in the other direction, where we set a stop loss at a higher value and take profits quickly. We naturally expect this to increase our win rate. Let's see by how much. So in this case, we set the stop loss to 500 pips and the take profit to 5 pips. We now have an eye-popping win rate of 87%. The system has generated 6,552 trades since 2010, but the return has dropped to 30%, that is approximately 25% lower than the early loss taker system. If we compare it to the original reversal system without any risk management, it is actually doing worse. That one had a 63.6% win rate and a 65% annualized return. The Sharpe ratio has also gone down to 0.63. In conclusion, the next time when you hear some guru cheering the win rate as an ultimate solution for profitability, ask why, maybe even ask them why. Backtesting a very simple strategy shows us that using an early loss taker strategy with an intrinsic lower win rate can be more profitable. It is naturally easier for you as a trader to be right more often than to be wrong, but that is a logical fallacy and is mostly related to ego rather than making money. So instead of focusing on maximizing your win rate, put more effort into researching your trading ideas and verifying them through rigorous backtesting. Would we trade this strategy? Absolutely not. We're not aware if it has any predictive power. As far as we are concerned, the good results might be just plain luck. There are many more steps that need to be done to have a strategy that we would consider for trading. We at System Traders are a group of passionate developers and traders with a combined experience of more than 10 years in the development of trading systems. Besides trading our own strategies on our own portfolios, we are developing bespoke strategies. Although it seems simple, building, testing, and running a strategy is not easy. The only way to be able to successfully run it is to know what to expect from it in the future. We can help you backtest, develop, and run your own strategy on stocks, forex, and futures. Feel free to get in touch for a quote on developing your own system. If you like the video, please give it a thumbs up and don't forget to subscribe. We are happy to run a backtest for you on an indicator of your choice for free if you just leave us a comment with the name of the indicator, instrument, and the lookback period.